Hi everyone and welcome back. Today I'm joined by Adam Tyley from Futurity Investment Group. Adam's a Queensland Business Development Manager at Futurity and brings more than 2 decades of experience in the financial services industry. In today's discussion, we'll explore the role of education bonds and how they can help families save and invest for their children's future. But before we get stuck into our discussion today, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, or needs, so it's not a recommendation. It's also important that you consider if what we discuss today is appropriate for you before acting on it. Also, please refer to any product disclosure statements or PDFs regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Hi, Adam. Thanks for joining us today. Most parents know they should be saving for their children's future, but many have never heard of an education bond. So what exactly is an education bond?
Thanks, Joel. An education bond is just another structure that you can invest through. The easiest way to explain it is if you think about superannuation, it is also an investment structure. You're putting money in for two reasons. One, you're forced to do it. But secondly, if you're investing in superannuation, your investment earnings are taxed at a lower rate of around 15% for most people. There's restrictions on how much you can put in superannuation, and there's also restrictions on when you can access it. So an education bond is very similar. It's another structure. You can put money in it. You're not forced to, but you can choose to put money into it, and you'll pay tax on your earnings at a maximum of 30% within the structure. So not quite as good as super, but still better than a lot of people's marginal tax rate. So that's the carrot. You're putting your money in to pay less tax on your investment earnings, and eventually when you take the money out, you should have more money left.
Okay. Well, who are the education bonds designed for?
So they're designed for a lot of people. I think if you're going to pigeonhole it, you'd go, it's for people like me. I'm on a high marginal tax rate. I've got 3 young children, all in primary school at the moment, and I'm already saving for their high school and their university. So that's probably where people originally would look. But what we're seeing nowadays is more and more grandparents are starting to set up education bonds for either existing grandchildren or grandchildren that they're expecting in the future. The stats is 71% of grandparents want to help grandchildren financially. And the two things they want to help with is education and housing. And education bonds can certainly help with that.
Okay. Can you talk us through how the tax treatment works on an education bond?
Yeah, no problems at all. So if we go back to the superannuation analogy from earlier, you put money into superannuation, it generates earnings, and those earnings are taxed at a maximum of 15%, and that's within the bond. So at the end of the year, you don't have to pay any additional personal tax. Sorry, that's within super. You don't have to pay any additional tax because it's being taxed within the superannuation structure. Education bonds are the same. You're putting money in, it's generating investment earnings, and those investment earnings are being taxed at a maximum of 30% within the structure. So at the end of the year, you don't have to pay any personal tax because it's already been accounted for within the structure. The interesting thing though with education bonds is you have this account, if you want to call it that, where you've got contributions sitting in one bucket and investment earnings sitting in a separate bucket. And it's the earnings bucket, obviously, where all the tax is being accounted for. But whatever's in your contributions bucket, you can actually withdraw that tax-free at any time. So unlike superannuation, when you put money into an education bond, well, you can always take it back out again. You don't need to meet a condition of release. You can then wait 10 years and you could withdraw your earnings and you don't have to pay any additional tax. But what you can also do with a bit of clever planning is you can withdraw the earnings to fund education expenses, and any tax that was paid will get refunded. So you can put money in, take it out tax-free. You can generate investment earnings that are getting taxed at a concessional rate. But if you're able to pull those earnings out to fund education expenses, then you actually get that tax refunded.
It's a bit of a game changer, isn't it?
Yeah, once you get your head around it, it's very flexible. I think that's what I like about it. But with flexibility comes a bit of complexity. So they have been around for about 50 years, but it's probably only been in the last 5 years that they've been promoted better, and financial advisors are starting to look at them and go, oh, hang on, I can see how this can help clients. And we're starting to see them used in a far more comprehensive way. So yeah, it's certainly a game changer. They're not new. They've been around for a long time, but it's probably only been in the last 5 or so years we've really started seeing financial advisors start using them and starting helping their clients use them to the best of their ability is the nicest way to put it.
Okay. So talking about how they're used, what can education bonds be used for?
Yeah. So as it kind of says on the label, education. But education isn't just school fees. It can be uniforms, tuck shop, transportation. It can be university. It can be HECS, it can be apprenticeships. I quite like travel, as do a lot of people. I might want to do a photography course, so it could be used for that as well. So it's not just fees, it's any expense related to education. But beyond that, as I said before, you put money in, you can withdraw that at any time. You can withdraw your contributions for any life event. So there is a misconception that education bonds can only be used for education, and that's just not true. There is a sole purpose test, which means if you're establishing an education bond, there needs to be a genuine intention to save for education. But if you never end up using it for education, you're never penalized. So whatever money you put in, you can access at any time for any reason whatsoever, tax-free. After 10 years, you can always withdraw all the money for any reason you want. But there's some significant tax advantages of using your investment earnings for education. So you do want to use it for that purpose, because you'll be far better off if you're able to.
Okay. So we talk about using education bonds for kids. Stop for a second and go back. We talk about using education bonds for kids' education, or grandparents setting them up for grandchildren or future grandchildren. Do any individuals set them up for themselves to fund education?
Yeah, absolutely. Often young professionals, they might be setting it up because, one, they have a HECS debt, or two, they're in an occupation where they're going to have to do some ongoing education. Or they might just be setting it up because they're paying, well, they're on a higher marginal tax rate, and this is a structure where they can invest and pay a lower amount of tax. And they're pretty confident that there's going to be education needs in the future. So they're setting it up for themselves, but also with that flexibility, well, hang on, I might get older, and I might have a family of my own one day. And when that occurs, well, I might add my children to this investment, and I'll end up using it for them, not for myself. So there's a lot of flexibility, but people are regularly setting it up for kids, grandkids, and often for themselves. We also see people setting them up for nieces and nephews. Occasionally you see it for friends and friends, but we also see them being set up for charitable purposes as well.
Okay. Can you talk us through the charitable purposes?
Yeah, so that's, I'll give you an example. I won't go into detail because I don't want it to, what's the right word? I don't want to expose anyone, and that's not in a bad way, just for privacy reasons. We have seen people that have been through certain schools, and they really want to help the school when they're gone. And so often they'll make a donation via the will to go to the school. But there's no reason why you actually can't set things up first. So I've seen one that's been set up for one of the private schools in Brisbane. And the idea is the earnings are actually going to be used to provide a scholarship for certain students in grade 12 and potentially help them go to university. So that's one example of where I've seen it used for more of a charitable purpose.
Oh, perfect. Now, you mentioned it can operate similar to superannuation, and superannuation has a lot of investment options.
Yep.
How do the investment options work in an education bond?
Yeah, thank you. I'll say similarly, if that's a word, but it's not as comprehensive, right? If you log into your superannuation fund and you look at your investment menu, it's very, very, very extensive. With most bonds, whether it's an insurance bond or an education bond, your investment options are probably going to be limited to somewhere between 10 and maybe 60 options. What we find with bonds is the vast majority of people that are using them are less focused on the underlying investment portfolio. Like, it's still very, very important, but it's more around what's the strategy and what's the structure. And what that means is people that are using bonds, they tend to use index options either for the whole portfolio or certainly for the core of the portfolio with some satellite options around it. But the main thing is when you watch TV, right? This is probably a good example. When you watch TV and you see the super fund saying compare the compare, in my opinion, that's incredibly misleading, because it's a super fund. The super fund's not dictating the investment outcome. It's the investment you choose within the super fund, and bonds are the same, right? So you put money into a bond or an education bond or an insurance bond, and you choose how you want it invested. And you'll find the majority of insurance bonds have very similar investment menus. But it's the investment you choose within the bond that's going to dictate your final return.
Sure, sure. Now, we've spoken about education bonds and super, but how does it compare to other structures or investing in your own name?
Yeah, good question again. So investing in your own name, that's probably the easiest one to qualify straight away. So if you invest in your own name, you're going to receive distributions. You're potentially going to have to pay capital gains throughout the year as the investments are pushing out distributions or capital gains to you. Whereas if you invest within a structure like this, the structure pays the tax on the investment earnings. So you can literally put money in and ignore it. Now, I'm not suggesting you do that, because you should always watch what's going on with your own money. But when I say ignore it, it means everything is being taxed internally. So you don't have to talk to your accountant about it at the end of every year. You don't have to worry about a tax bill coming through at the end of every year. And the idea is, obviously, if the bond pays tax at a maximum of 30%, often it's lower than that, but we'll say it's a maximum of 30%. Well, if you're on a marginal tax rate that's higher than 30%, well, then pure maths would suggest that you'll have more money at the end of the investment if you pay less tax on your earnings on the way through. So that's if you're using it personally. The other advantage of bonds is money within a bond is actually protected from creditors, and it's what's called a non-estate asset. And that's why we see grandparents using it. They can put money into a bond, and if they pass away, they don't need to worry about other family members fighting over this money because it sits outside of the estate. And while it can be contested, you're not going to win because it's a life insurance. It's deemed to be a life insurance product, so it's got its own protections. So that's using it personally. Probably the other comparison would be family trusts. I think it was May 16, Mr. Chalmers came out and spoke about capital gains tax and negative gearing. I'm really surprised there wasn't more media attention to the proposal to tax discretionary trusts at a flat rate of 30%, because that's huge. So a lot of people used to sell assets, put money into super, pay off debt, and then put the balance into a family trust, and then they distribute the earnings from the family trust in the most tax effective way possible. That might not be possible in the future because I won't say theoretically, you'll actually have to pay 30% on all distributions before it goes to a beneficiary. So in the past, you could distribute money to an 18-year-old who wasn't working, and that would be a tax effective way to get the distribution out. But in the future, no, that money needs to be taxed at a rate of 30% before it goes to the 18-year-old, which is the equivalent of putting that 18-year-old on a salary of $170,000 before distributing to them. So that's starting to look very tax inefficient. So we think in the future, more people might start using bonds. I'll put money into super, I've cleared my mortgage, I'm now going to put the balance into the bond. Knowing I can access my contributions tax-free. After 10 years, I can pull it out and not pay any personal income tax. And along the way, I can also distribute the investment earnings for education expenses and get that tax refunded. So a bit more flexible and potentially a more tax-effective solution than what family trusts have been in the past.
Okay. Well, to summarise some of the things that we've gone through today, who would you say should consider an education bond today?
Anyone, obviously, with children that are on higher marginal tax rates. This is actually a very good strategy, even if you're on a low marginal tax rate, because if you're able to use the earnings to fund education expenses, well, any tax paid is going to get refunded. So it will work for everyone, but it's very easy to see how it's going to work for people on higher marginal tax rates. I also think grandparents, that grandparents and retirees, because really that is where I think you take advantage of all of the features. So the fact that you can put money in, but know it's still available to you if you want to upgrade the caravan or go on a cruise. I don't want to generalize anything, right? But if 3/4 of grandparents want to help grandchildren financially, well, this is a really good way to do it, right? Because you can always access your own money. You know there's going to be money there to help get them through high school or university. If there's a balance at the end of it, well, now you've got a deposit to buy a house. But over and above that, if you structure it correctly, you know there's not going to be any estate disputes. You can also set it up like a bloodline trust so that rather than giving money to adult children early, which is then at risk of, well, if they separate, half of that early inheritance disappears in the divorce settlement, you can put it into a bond and you can protect it from those situations as well. So parents and grandparents, in my opinion, are the most obvious people that should be at least looking at these and thinking, is this appropriate for my goals?
Okay. Well, the flip side of that, who would it probably not suit?
Well, the obvious one is people that have zero intention to save for education. Because if there's no intention to save for education, you shouldn't be using an education bond. But for most parents and grandparents, right, well, it's there. So that's kind of hard to discount a lot of people. I struggle to come up with examples of people that shouldn't consider it. Whether or not you use it comes down to your personal circumstances, and that's why you should work with your advisor to figure that out. But most people should consider it. There's really only been one where I've had to say, oh, look, I don't think that's appropriate. And this was quite an interesting situation where someone was about to go to prison and people wanted to put money away for them. So when they got out, they were taken care of. And I was like, well, I don't think this is the right strategy for that individual. Maybe consider option A, B, or C instead.
Yeah, right. Yeah. Okay. Well, what's the one thing parents should know before establishing one?
They should know their financial advisor. Sorry if that sounds cliche, but we really encourage you to work with a financial advisor when looking at education bonds because they are flexible, which is a really nice way of saying they are complex. So that's the one thing, know your advisor, talk through it with them. And I'd probably just leave it at that. Like, I think you can jump on Google and you can get all sorts of information, and the majority of it is going to be misleading. Talk to your advisor, make sure you understand it properly, and make sure you understand it if it is actually suitable for you.
Well, Adam, we've covered a lot of ground today. Is there anything else you'd like to share with our viewers before we leave you?
It sounds cliche, but I'd say probably the most important thing you need to know about education bonds, well, it's less about the education bonds. It's more so you need to know your financial advisor. And the reason I say that is they are incredibly flexible. But with flexibility comes quite a lot of complexity. And we want to make sure if people are putting money into an education bond, it's going to be a really good outcome for them and their family. So we encourage you to go and see your financial advisor and work out if it is right for you. Beyond that, some of the most interesting strategies I see, again, it's when grandparents are using these bonds for grandchildren, but they're also using it as a major part of their estate planning strategy. So I spoke before about how you can set money up and it's protected from the estate and it's protected from the adult children getting divorced. But another really interesting thing happens in the unfortunate event where the bond owner, i.e. grandparent, passes away. The bond, in simple terms, shifts into what I call testamentary status. So it just means the money remains invested for all of these grandchildren, but it's protected from the grandchildren and it's protected from any relationships those grandchildren get themselves into, and it's protected from any lifestyle choices those grandchildren might make. But the other interesting thing is you can then start distributing the investment earnings to those grandchildren, and those grandchildren will be taxed as though they're 18 years of age, even if they're only in primary school. And that's another key benefit of testamentary trusts. So in summary, education bonds can do a very good job of mimicking testamentary trusts. And that makes them really good for people that want to leave small amounts of money for another generation, and they don't necessarily need the complexity of a testamentary trust, or horrible situations where people have passed away and they should have had a testamentary trust, but they didn't. So again, these are the sort of examples where I really encourage people to work with their financial advisor to make sure it's appropriate and make sure it's done properly.
Okay. Well, Adam, appreciate you making the time.
Thank you. My pleasure.
If you'd like to know whether an education bond could be appropriate for your family, reach out to Solace Financial via our website or contact us via phone to schedule an appointment.